Great, okay. Well, so I'm Ed Conway, I'm economics editor for Sky News. I'm merely chairing this, and it would be fantastic just to have as much in the way of contributions from our panel as possible, and then questions from the floor, because there's so much to get through. We've only got an hour, so I will be brief. I hope that as many of you as possible have read Help to Save, James's pamphlet, which is absolutely fantastic. Of course, Help to Save, the irony in the title is that right now Help to Buy really is about help to borrow, and there are very few in the way of coherent policies being talked about right now about how to sort out the pensions time bomb that James documents here. And I am obviously not excluding Lord Turner's work on this some years ago. The number of people over 65, that's set to rise. I'm stealing most of this from James's research as well, so apologies to you. Number of people over the age of 65 is set to rise from about 17% now to almost a quarter by 2050. The ratio of those in work to those in retirement, that's going to fall from 3.2 people, obviously, who are in work to those in retirement, to less than 3 by 2050. The average pension pot is currently £36,800. That's enough to generate retirement income of just £1,340. There's a real problem that we may be sleepwalking our way towards when it comes to pensions provision. And more needs to be talked about it. And we need to deal with this, perhaps as we're dealing with other types of crises, because there could be serious long-term economic implications if we don't. The panel today is really as broad-ranging and as perfect as we could have asked for. I'm going to introduce them briefly, and then each of them is going to talk for about 5 minutes or so, and then after that we can have some questions. I'll do introductions first. James Barty, Senior Consultant to the Policy Exchange on Financial Policy. He assumed this position in November 2011 after almost 25 years in the city, and he's published work on executive pay, Bank of England reform, capital requirements, and privatising RBS and Lloyds. Lord Turner was until recently chairman of the Financial Services Authority. He played a leading role in the redesign of global banking and the shadow banking regulation as chairman of the International Financial Stability Board, their major policy committee, and he's now senior fellow of the Institute for New Economic Thinking, and he has a book out quite soon, but it's a work in progress. Mark Hoban will be joining us. I'll introduce him when he comes. He's currently voting in the chamber. Alan Brown is senior advisor at Schroders. He joined the group in 2005 as chief investment officer. Prior to that, he was at State Street Global Advisors. He's worked at a panoply of the city's finest institutions, going all the way back to 1974 when he joined Morgan Grenfell as an equity analyst. And finally, Helen Morrissey is the editor of Retirement Planner and deputy editor of Professional Pensions. She's written on pensions from both an occupational and a retail perspective for the last 10 years, and she writes and commissions articles across a whole range of different retirement topics, but specialises in the at-retirement and post-retirement areas. So, first of all, James, why don't you start us off, and then we will hear from Lord Turner and all the way down.
Thank you. And if any of you have not had a chance to read this wonderful publication, I can urge it on. I didn't pick the pig, by the way. That was Matt Smith here in the front. Now, Ed's stolen some of my stats, so I should be able to get this down to 5 to 7 minutes. When we started to look at this, we obviously referred back to the Pension Commission that Lord Turner set up just about a decade or so ago, which was in recognition of the huge hole that existed in pension provision in this country. And the changes made in the light of the Commission's recommendations, notably auto-enrolment and a higher pension age, have helped close some of that gap that existed, but it doesn't, in our view, go far enough. And in this report, we argue that much more had to be done if many millions of future pensioners are not to live on inadequate incomes. Now, the one stat that Ed left out was that apart from the number of over 65s going from 17 to 24%, the number of those aged over 85 and over, which sadly will include me by that time, we'll see their proportion rise from 2 to 6%. And these people are people that very much use a lot of the state, and they're very expensive to care for. And if you look at the strain on the government finances from the NHS, long-term care provision, it's just going to be overwhelming unless people save enough towards their own retirement they can fund that themselves. And currently we just save far too little. The government's own figures suggest in 2012 some 40% or 11 million people between the ages of 22 and the state pension age wouldn't save enough to meet the required or recommended replacement income for retirement. And a Prudential survey said that roughly 1 in 7 were planning to rely entirely on the state pension in retirement. And even those who are well positioned enough to already be in a defined contribution pension, some 57% of those said that they weren't confident enough that they were saving enough for their retirement. Now, the introduction of the single tier pension and the auto-enrolment was an attempt to address these issues. Now, the single tier pension that's what the government will pay you when you retire. It's about £143 a week at the moment, just over £7,000 a year. And it has been changed. It is more generous now. It goes to a level where most people will be able to at least have that, because at the moment, under the current existing pension schemes, if you've not worked for long enough or you've been out of the labour force, you can end up with something much less than the current state pension. But it can only be a base. The government has little or no room to basically extend the current provision. And already the OBR is saying that pensions will go from 8.4% of GDP to 12.5% of GDP by 2050. So people have to save for themselves. Now, let's look at auto-enrolment. And why did we conclude in our paper that you had to go down the compulsion route? To put in context, a person on average earnings, so about £27,000 a year, their recommended replacement income is about £16,000 a year. Now, at current levels of annuity yields, and Aaron Brown's going to go on to talk to those a little bit later, you need a pension pot of about £240,000 to generate your target replacement income. Now, Ed mentioned that the average pension pot at the moment is £36,800, so you can see there's a massive gap between where we are currently and where we've got to get to. Now, a person contributing under auto-enrolment, they should do better than that £36,800, but not well enough. If you contribute 8% of your income at a real return of 3%, which is pretty reasonable given the historical comparisons, non-stop for 40 years, you get to a pension pot of about £130,000, or about 55% of what's needed. Now, that's what you get under the government's auto-enrolment scheme. We worked out that if you wanted to get to the targeted retirement income, you need to save about 14.5% of your income at current annuity rates. For those on higher incomes, the numbers get higher to 15 or 16% because that base level of state pension is a much smaller proportion of your pension overall. Now, our numbers were backed up by the Pensions Policy Institute. They calculated that even if you saved over a 48-year period under auto-enrolment, the person on medium income would have a less than 50% chance of meeting their targeted retired income. And for higher earners, again, that drops to about 40%. Now, our calculations and theirs assume that people don't opt out of auto-enrolment. One of the problems of auto-enrolment from our perspective is you can opt out of it. And as soon as you do so, you have a massively reduced chance of actually meeting your target retirement income. Someone who takes a 7-year career break, for example, sees their chances drop from just under half to about 34%. Anyone who doesn't start saving until they're 40 only has a 5% chance of meeting their targeted retirement income. Now, the DWP has said it doesn't want to raise the minimum contribution rate for fear of increasing the numbers opting out. Now, from where we stand, you've got to increase the contribution rate. So if you're worried about people opting out, the only solution is to make it compulsory. Now, there are many people, and I'm sure there's some in this room, who say or actually hate the idea of anything to do with compulsion. But I regard pension contributions as being like taxes, like national insurance, like education. It's something you should have to do, because if you don't, you're really relying on other people to bail you out. So, to my mind, there is no choice. You have to go down this route. Now, what we said is let's assume that annuity rates go up somewhat from where they are today. We factored in a 25% increase, which is not unreasonable. It kind of takes annuity rates back towards where they were in 2007. You can then just about get away with a 12% contribution, so about 50% higher than they currently are. And on using the same ratios as the government does at the moment, that's 6% for the employee, 4.5% for the employer, and 1.5% for the government. Now, many other countries have compulsory savings schemes. I would point to Australia. I think many people tend to, and I think it's worked relatively well. And you can see, if you look at their savings stats, that they've gone from an era of undersaving to an era where they are actually now saving decent amounts in Australia, and I see no reason why it can't work for the UK. Now, compulsory pensions are something which the government's been reluctant to do, I think something which they have to do, but it's not the only problem with our pension scheme. And in Help to Save, we actually outline a number of different issues. Now, some of the other contributors are going to deal with those later on. The type of things we advocate much more flexibility in your ability to draw down your income. There's a presumption at the DWP that you have to have an annuity. Now, given that annuities are tied to government bond yields, which are very low at the moment, we don't think that's a particularly good idea. We'd like to see much more flexibility about taking equity income or some other form of bond yield income. Secondly, we'd advocate a change in the annuity market. And I think Alan's definitely going to talk about this, but we said in the paper that we would like to see the annuity market split out between the interest rate risk, which we'd like to see covered by a government bond being issued, and then the life assurance risk, which we would like the insurance companies to effectively insure the tail risk. So rather than insuring someone at 65, we'd rather the insurance industry insure people from 85 onwards, because then you really are taking life assurance, whereas there's much too much interest rate risk at 65, which is not their area of expertise. Then we looked at the fragmented state of the UK pension market. And one of the issues which I'm quite concerned about is that DWP have put all of the emphasis on the employer and said, right, you the employer, you choose the pension fund or the pension system, and your employees have to opt into that. Now, if you move from one employer to another, you're going to be jumping from one pension provider to another pension provider to another pension provider. Now, the idea is that the pot follows the employee, but clearly, there's a very good chance the employee, after about the third or fourth time, just said, I've had enough of this, I'm going to stop, if you've got an opt-out. The Australian system, where you're in sort of these kind of super trusts, I think is a much better idea. It'd be much better if you, as the employee, choose your pension pot, and then just the employer pays into your pension pot. It's much more likely that you're going to have ownership of that. I actually now work for the British Bankers Association, and my boss there, Anthony Brown, has got a maths degree, but he tells me that he's got 6 pension pots, and even he can't work out what his eventual pension income is going to be, so he's actually saving elsewhere. So, I mean, there's all sorts of problems with that. In summary, really, what we're saying is that there's been a lot of progress made in the last decade, but we can't stop here. Pension saving has to go much further if we're all going to have enough income in retirement. And anything which weighs against pension saving is a bad idea. And just to finish on that note, I thought Ed Balls' proposal to actually limit pension contributions to basic rate relief was a particularly bad step in the wrong direction. Thank you.
Thank you very much, James. Lord Turner.
Good. I won't stand up. I'll do it from here. Well, thank you very much. I think this is a very valuable contribution to the debate about pensions. And I think we were very well aware when we did the Pension Commission work, which is now 9 years ago, that we were taking a step forward in what we proposed, but it wasn't going to be the end of the journey. What did we achieve? I think we managed to achieve breaking a set of log jams in UK pensions policy. We were very well aware of some of the time bomb issues, the problem that people were not saving enough. And we were very well aware that the existing significant element of pensions, which was delivered by defined benefit pensions, was dying. Though, by the way, don't overstate defined benefit pensions. Most people never had them. Even at the height, this was sort of 11 or 12 million out of a working population of 27 million. We had pretty bad pension provision even before the defined benefit scheme began to die away. At the core of what we proposed were, first of all, removing a logjam in the state pension system, and that was by insisting that the state pension age had to go up. Now, I remember this very well because up until 11 o'clock on the morning of November the 30th, 2005, no British political party had said that the state pension age had to go up. I stood up at a press conference at 11 o'clock on the morning of November the 30th, 2005, and said the state pension age has got to go up. And by the 6 o'clock news, all 3 political parties were committed to the state pension going up. Now, we suggested taking it to 68 by 2045. I always thought we'd have to be higher. The present government, I think, has quite rightly accelerated that. We'll get it to 69 by 2045. The reason why that removed the logjam is that it then became affordable to link the state pension to average earnings. As long as we were promising it at an unchanged age, you could only make it affordable by linking it to prices. And if you linked it to prices, you were sucking more and more people over time into means testing against the minimum income guarantee. So at a higher age but links to earnings was an absolutely fundamental element of having something which didn't create a means testing problem. But we always knew that there hadn't been enough progress on that, and have been very pleased, I have to say, to see the subsequent move towards the single-tier pension, the simplification that people are going to get £140 a week, rising in line with average earnings, or indeed with the triple lock. That provides, as you said, nothing but the base load, but at least it provides a base load, and at least you can now save on top of that without the problems of means testing, which we were worried previously undermined the incentives for private savings. But in addition, we went for auto-enrolment, and that has turned out to be, so far, a significant success. In fact, the percentage of people accepting auto-enrolment is higher than we had anticipated. So far, and I know at the moment it's only been among the larger companies, so we'll have to see what happens when we move to the smaller companies, we're hitting about 90% of people accepting auto-enrolment and staying in. We'd hoped it might be 80% or so. And I think as a general principle of public policy, it does illustrate that these nudge, these inertia ideas, these ideas that build on behavioral economics do work. So state pension, single tier, higher, rising with average earnings at a higher age, auto-enrolment. I think at least we can say we have a more coherent base load than 8 years ago. 8 years ago, we didn't have a coherence at all. We just had a complete mishmash. And I think there is now an acceptance that that fundamental architecture, a state pension scheme that keeps you out of absolute poverty in retirement, but you've got to build on top of that with private pensions. I think people accept that. And that's good that we've got that degree of consensus. But do we need to do more? Well, I first of all want to make one point, that one of the things we need to do more is to get people to work later in working life. I only want to say this because I always have to say this. But no pension system, no mucking around with getting people to save is going to work unless we actually get people working longer in working life. All pension systems, funded or unfunded, involve in some way a transfer of resources from people who are consuming less than they are earning to a group of people who are consuming but not earning. And people sometimes think there's a massive difference between pay-as-you-go or funded. In that respect, they're the same. The money moves in different ways, but it still moves in some way, either through the financial system or the tax regime. So the ratio of those who are not working to working is so fundamental, and we have to keep coming back to that. Now, I sometimes think it's slightly better than maybe the figures in here suggest, because I have a sort of bugbear about us continuing to refer to the number of people aged over 65. I mean, really, when we do these ratios, if anything, we ought to say the number over 65 to below 65 up to 2020, the number over 66 to below 66 beyond 2020, and we should only have this ratio in 2045. It should be the number over 69 to below 69, because we're already committed to that. But that is a crucial ratio. I will say honestly, I would have liked in the Commission to go further at the time. I suspect we should maybe go further still. I think 70 by 2040 would be a good thing to aim at. But it isn't just the age at which you get the state pension. It's also that people are working up until that age. And by the way, that means that a set of things which are not in pension policy are very important. Health in life is very important. The obesity debate is very important. People keeping active is very important. I think it is the case that healthy can be aging. Now, maybe that just reflects the fact that I'm getting on, and I used to, feel it was good because 50 was the new 30. I'm now increasingly concentrating on 60 as the new 40. But I do think the evidence is aging can be healthy. People can work later. And by the way, for most people, leaving the workforce too early in life is a bad idea. People need the social involvement of work. But there are other aspects of policy. That is fundamental. But leaving that aside, should we do more in terms of what people are saving? Well, I think ideally we should. In the Commission, when we came up with that 8% figure, We were very aware that that was the minimum. Indeed, I think we did modelling, if I remember, which used figures of 15 or 16% and said that's really what we'd like people to save at. So it doesn't surprise me when you say that's the sort of figure that you need, 14, 15, 16%. We wanted to get the thing going. There's an art of the possible in politics, of getting things going and seeing where it is. We knew that 8% wasn't sufficient. The issue then is, what do we do about that? Do we, at very least, the thing we should definitely do is encourage people and make it easy for people to go above the 80% auto-enrolment. So at very least, we ought to be telling people, this is not going to be enough for your retirement. Here are indications of it. This is what you'll get from the state. This is what you'll get from your private pension at the moment. Be aware that you need to get more. At very least, we should be making it easy to save more. I have to say one of the unfortunate compromises which was made with the pensions industry back in 2006 was a limit on how much money you could put into Nest, the national state-provided option, which therefore made it more difficult for people to say, oh, well, in addition to my 8%, I want to save at 15%. Can I put it all together? We have encouraged a fragmentation of pots, which was unnecessary. So I think there are some things we should definitely do. We should encourage people. We should educate people. We should make it clear that they need to save more, and we should make it easy for them to save more. But should we go beyond that and have both a higher rate? And I think you're absolutely right, the logic. The higher we make the rate, the more we will probably have to have compulsion, because otherwise, if we simply try a higher rate with auto-enrolment, we'll probably get undermined by a larger number of people pulling out. There is a case for compulsion. I think your arguments about, okay, we've got people in, but once people leave for a few years out of the workforce, that will undermine the amount that we're putting in. Another argument for compulsion is, how do we deal with the self-employed? The self-employed, I have to say, is one of the great conundrums in pension policy. And we know that over the last 4 or 5 years, we're getting a very significant increase in the number of people who are self-employed. We're going to probably have more and more people who, during their life, move between formal employment and self-employment. How do we deal with that? Well, compulsion can cover a self-employed in a way that auto-enrolment is very difficult in the self-employed space. So I am bluntly open-minded about whether at some stage we have to go to compulsion and at a greater level. And that reflects the fact that when we did auto-enrolment, our attitude was, to a degree, the art of the possible. We liked the idea that it had the opt-out. Maybe there are forms where we sort of make it even more presumptive. You're in unless you can really prove to me that you don't need to be out. There may be, and I think you suggest in that, some sort of points along the spectrum. But the final two things I want to end with is, if we move to compulsion and higher rates, it makes it even more important that we make sure that people get good value for money. We can't compel people to save and then say, okay, I've compelled you to save, and I'm now going to allow the industry to take large asset management fees out of you. So you've really got to then think, even within auto-enrolment, we thought about how do we enable people to get a good return on their money. And fees matter a lot. If you pay 150 basis points, 1.5%, and you save for 40 years, by the time you retire, you will be 20% worse off than if you had been able to save at, say, 10 or 20 basis points annual management charges. And some people enjoy 10 or 20% annual management charges. Who are they? They are the people who work for large employers who are achieving economies of scale in the provision of pensions at the administrative end, and who are then able to negotiate with the fund management industry on a bulk buying basis. So the more we go down the compulsion route and the higher we make it, the more that we've got to think about how do we get economies of scale and how do we get bulk buying at the wholesale fund management level. And therefore it's not surprising to me that you've said that the logical consequence of that is to look at the super trusts. There are big debates even within what we've got at the moment about how do we stop the proliferation of small pots. where through either a pot follows members or what's called an aggregation technique. But I think the more we go down this, even with what we've got at the moment, we've really got to make it easy for people to get all their pots together, and we've got to have a large economies of scale. The issue you then get, and it isn't in here, is if you're going to go that far, why don't you just have a state-run scheme at retail level and only go into the fund management at wholesale level? That's what the Swedes do. The Swedes have, on top of the basic state provision and on top of a thing called the notional defined contribution scheme, they have a thing where you say, the national insurance scheme, because it's compulsory, is going to take your money, it's going to accumulate it, it's going to provide you each year with a wonderful logical thing called the orange envelope, which all Swedes get each year, which tells them very clearly how much money they're going to get from the state, how much money they've now got in their funded pension scheme, and which then asks them each year, where do you want your money invested? Here's 200 schemes, funds that you can choose to go to at wholesale level, but 5 of these we've bulk negotiated for you with very low fees down at the 30 or 40 or even lower basis points. I think the more we go through compulsion, the more we have got to be willing to use the power of the state or the encouragement to super trusts to really end up with low annual management charges. We can't compel people to save and then start taking money off them. And so I think the one thing I was not so sure about this is it was saying cap fees at 1%, not 0.075%. I don't think it's okay to compel people to save and then there being any danger that they're paying 1% fees. I think we've got to get it lower than that. The final point on annuities, some very interesting stuff in here about annuities. I fundamentally don't think people should be buying annuities at age 65. I think if you buy an age at 65, the provider has got to allow for the still remaining longevity risk. And there's a significant degree of uncertainty as to how long your cohort is going to live, which exists at 65. So some of the ideas here about how do we more intelligently deal with the drawdown process are very important. And in particular, and I know Alan wants to talk about this, the issue as to whether we can use the liability side of the state's balance sheet, i.e. what the debt management office does, in order to help people hedge their risks on the asset side is very important. The final thought I have there is, what we saw before the financial crisis was a lot of bad financial innovation. The world really never needed a CDO squared. What is one of the unfortunate things is we've had a surprisingly small amount of good financial innovation, things like GDP-linked bonds or particular forms of debt management office annuities. I think that is a fertile area for inquiry.
Thank you very much indeed. As if by magic, on cue, Mark Hoban has arrived. I will give you a quick introduction. He's Conservative MP for Fareham. He understands economics. He has an economics degree from the LSE, nonetheless. And after graduating, he qualified as a chartered accountant. He's worked for PwC, where he was senior manager. He has been financial secretary to the Treasury from May 2010 to September 2012, and Minister of State for Employment. And he is here to talk as well. And if I could ask you to try to keep within the 5 minutes. Adair was a little naughty there, but unfortunately we will be disciplining people for running over time now. But if you're good to talk now, then that would be great, Mark.
Well, Ed, thanks very much. And I apologise for being late. We were voting, and I managed to successfully dodge the 24 bus and tourists to get across here in time. Adair really was just filling in time to make sure rather than have some sort of embarrassing silence. I want to talk about 2 points that emerge from James's work. And the first one is to follow on from what Adair was saying about annuities and to step back a bit. Because I think that when actually people get to retirement now, it's likely to my mind that actually their pension pot will only be one of a series of assets that they will have at retirement. You know, they will have a house with equity in it. They will have ISAs. You know, and there are signs that people are building up six-figure sums in ISAs at the moment. You know, and they will perhaps have a DB scheme, depending on their age. They'll have a DC scheme. There'll also be the capacity for people in that early stage of retirement to work part-time. And I think one of the challenges we have is to get people to think about retirement and to think about that range of assets that they have and think about when they use those assets to provide retirement income, thinking about the profile of their income over the profile of not just their income, but also actually their expenses over retirement as well. And particularly, I think, given the number of people now who are concerned about care home costs, notwithstanding the cap that's been introduced in the care bill, which we've been voting on today. And I do think we need to spend some time thinking about that decumulation phase. And I think the work that Steve Webb has done on single-tier pension, there's been a huge amount of focus on the accumulation phase. There hasn't been comparable focus on the decumulation phase. And that's where I think some of the innovation that we need could actually come into play. And I think, and I want to talk a bit about that in a moment, but I think in the same way that we have had consumer groups, industry, regulators, government working together on the accumulation side, I think we need to do the same on the decumulation phase too. And recognising actually there have been significant changes in the pensions landscape, even in the last 3 or 4 years. So we moved when I was at the Treasury to scrap compulsory utilisation at 75. One of the parts of that was actually you could only move to the most flexible drawdown policy if you had an income of £20,000 a year. I'm not sure that holds for people who are going to have a single-tier pension. We're actually not going to be means tested. They're not likely to fall back on benefits. And so we need to make sure that our decumulation phase reflects some of the changes that have taken place in the pensions landscape, even over the last 2 or 3 years. I think there is a challenge about the binary choice we seem to have at the moment between annuities on the one hand and sort of drawdown products on the other. I think for a lot of people, the certainty that comes from having a guaranteed income, a fixed income for the duration of your life is actually very important. But there are people who actually, I think, see the benefits of a drawdown policy. Perhaps they have the decent-sized pot, they have the capacity to take on that interest rate, the investment risk, to take on the longevity risk. And at the moment, we're sort of two polarised camps. And I think as more people build up a pot in retirement, I think we will need to see a wider range of products for people so that perhaps do create and guarantee a minimum income through an annuity-style product, but also give some flexibility to people to preserve some capital for later towards the end of their lives for care home costs, to enable them to recognise and to build up a bigger pot. Because if people are going to be retired for 20 years, being stuck in gilts for the whole of that 20 years may not be the right answer. And they may want some equity exposure. And of course, a form of drawdown product does give that equity exposure. The second point I want to make, and you please said this is the final point, so I will keep this. And it just picks up on Adair's point about the Swedish orange envelope system. We've got a slightly perverse setup at the moment. We don't want savers to think too much about building up their pension, because if they think too much, they might opt out. And so we want them to be passive. Yet as soon as they reach retirement, we want them to sort of lurch into a frenzy of activity and shop around. And it's quite hard to get people from doing nothing to doing lots in a short space of time. And I think that if we want to get people to think more about their retirement, we need to find a better way to communicate with people. And the Swedish orange envelope is quite a straightforward tool of doing. I was thinking about my own pension situation. I've got 3 defined benefit schemes, 2 defined contribution schemes, 5 lots of paperwork, arriving at 5 different times in the year. I can manage my way through them. I'm not sure many people can. But you need to aggregate information yourself. You need to put it together. You need to think about, well, if I want to retire earlier or retire on a higher income, what do I need to do? That's a series of quite complex decisions. Drawing together different bits of information. And I think that a lot of people approaching retirement in their sort of 50s will be faced with similar choices. And one of the other innovations in Sweden is to draw together all that pensions data in a single document on a website, alongside a ready reckoner, So actually people can look at what their pension needs are, look at what they've got at the moment and decide, okay, so I save an extra £100 a month. What does that mean for me in retirement? What does it mean about the lifestyle I can lead? And I think there's a big piece missing here, which is around advice, around guidance and information. And I think an initiative to try to bring together a lot of that savings of information about the pension pots people have, perhaps about their ISAs in one place, will I think help give people much greater control over their retirement plans. I think for some it may well scare them. We'll realise they won't have as much as they expect in retirement, but that could also be a call to action as well. And get people to do more. I think the final piece of that jigsaw, and it goes back to where you and I first met there, is with the regulator. We actually need to make sure there's a regulatory solution that enables people to draw together those strands, that there's a regulatory solution that enables people to come up with digital advice models to help serve the mass market. And that does require some regulatory certainty and some guidance. But I think if we've got that, I think we can put together quite a strong advice package that will enable people to take control of their plans in retirement. Think about how much they contribute. Think about going beyond the minimum that's required by auto-enrolment and actually empower people. And I think in this radically different pensions landscape, we will give people more choice. We also need to give them more tools to exercise that choice and to think about their futures.
Great. Mark, thank you very much indeed. It may be complex, but I've got to say I'm probably not the only person who's rather jealous of your millions of different pensions. So they all sound very nice indeed. Alan, next of all, Alan Brown.
Right, thank you. Just picking up on a couple of points from Mark there, I think the issue of advice is really... And it would be extraordinarily helpful if we could create a framework where there were some safe harbor provisions to allow well-meaning advice not to be so at risk from a legal point of view. You did also make a point, Mark, about the certainty of annuity income. And my only problem with that is that most of these annuities are fixed rate annuities, so they're not giving any certainty in real income terms, which is what really matters. But what I really want to concentrate on is, in the context of this big issue, big problem, is some low-hanging fruit where I think we can improve outcomes, particularly for those with small retirement pots, at actually no cost to the Treasury or the public exchequer. So today, if you are a 65-year-old male with a 60-year-old spouse in reasonable health, and you've got £100,000 and you want to buy an annuity which will provide a 5-year guarantee, 3% annual increments, and a 50% spouse's benefit, all you're going to get for your £100,000 is £3,700 of income. And that's appallingly low. Now, part of that is because of the depressed state of the government yield curve as a result of QE, but even allowing for that, it's a very poor proposition. There are, I think, two perfectly sensible options. Now, we need to remember that before you're free to act on your pension pot as you would like, you need to cover the minimum income requirement of £20,000, and today that can only be covered by the state pension and any DB and annuity income you've got. I propose that actually you should be allowed to credit 80% of eligible income, and I'll explain what that is in a moment, towards that. What do I mean by eligible income? Think of just a regular equity income fund here in the UK. You can buy one which will yield, say, 4.5%, usefully more than 3.7%. But the economic proposition is so much better than that. On first death, the spouse's pension is now 100%, not 50%. On second death, the estate, instead of getting nothing, still has the full value of the fund. And were there to be a bout of inflation sometime in the future, well, the fixed increments of 3% per annum behind an annuity will not protect you, whereas dividend income, which over the long haul grows pretty much in line with nominal GDP, would give you an opportunity to protect it. So, economically speaking, a much better proposition, and one which could be accommodated by platform providers through a modified version of an ISA platform. I think it really deserves serious consideration. The second point, which James alluded to, is also the possibility of engaging with the Debt Management Office to try and create better annuity propositions. And what I'm thinking of here is separating this issue of the tail-end life risk from the bulk of your retired life. And the notion that I have, which I actually think would be very good for the Debt Management Office, as it would be nice long-duration debt, is to sell a government bond which is constructed in the following way. It pays out nothing for 10 years and then pays 25 annual payments incrementing at either a fixed rate or with inflation for the next 25 years with no bullet payment at the end. So it is precisely constructed as a deferred annuity and would allow DC providers to come in and buy this through NS&I, for example, and to do so and layer up deferred annuity income, which would then be ready for them when they're ready to retire at the age of 70 or whenever. So I'll stop there in the interest of time, but I think there's some low-hanging fruit which can particularly help those with relatively small pension pots.
Great. Thank you very much, Alan. Helen, finally.
Great, I will keep this very, very quick. Can I just start off by saying that auto-enrolment has so far, I think, exceeded everybody's expectations. You know, we all remember the news reports, you know, predicting 30% opt-outs. The reality is that so far we're looking more like 10%. I think the most recent figures from the pensions regulator show that we've got 2.9 million people auto-enrolled into a qualifying pension scheme, and I think that is something that needs to be celebrated. However, I think there is still much more work to be done. Today's report is right in saying that current auto-enrolment maximum contributions are too low, and they're going to need to be raised if we're going to see decent pension pots built up in the future. And I think this is where we are going to see some problems. The UK is not a nation of savers, even at the best of times. There was a recent report by Legal & General called Deadline to the Breadline, which showed that when faced with a sudden stop in income, the average person's money will run out in just 26 days. So if people aren't putting enough aside to deal with even their day-to-day financial needs, how can we expect them to put aside enough to deal with their retirement? I think while initiatives like Save More Tomorrow have seen some success, I think the engagement vacuum that we've got here is currently so vast that I think we need to see compulsion come into force. I think as pension contributions rise, as they have to, we have to do all that we can to ensure that people continue to pay into a pension. I think there are lessons that can be learned from overseas. At the 2012 NAPF annual conference, Lorraine Berens of Aussie Super Fund Q Super actually called on the NAPF to put compulsion at the top of its agenda because she believed there was little chance of actually getting people to engage on a vast scale. In addition, the UK shift from DB to DC pension provision is unstoppable, but we need to see changes in people's behaviour as a result. The move to DC places so much responsibility on the individual, and yet many people still remain firmly in the DB mindset where responsibility is still placed on the employer's shoulders. I think as long as people continue to think this way, they're not going to engage with their pensions and they're not going to get decent outcomes as a result. I know that this does sound harsh. People's finances have really suffered a battering as a result of the financial crisis. And the last thing that they want to do is to make extra allowances for increased pension contributions. But the fact remains that people stand no chance of a decent retirement income if they haven't put enough into their pension to begin with. In addition, a lot of people said about the impact on companies. Companies are having a hard time as well. They don't want to put more away for people's pensions. But the fact remains is that if people aren't saving enough, they're not retiring early, and that causes many problems for the employer as well. As a nation that's chronically undersaving, this has to change. I think we're hearing too many stories of pensioners living below the breadline, and this does have to stop. I know the general public won't thank us today if we go towards compulsion. I think that there will come a time when people enter the workplace with the expectation that they will be paying a decent pension contribution, and it'll become normalised. I think as people start to build decent retirement pots, they will start to engage with them more. And again, if you look to Australia, there's certainly a greater level of engagement than there is over here. So let's not forget that those that retire with larger pensions as a result of paying in more. The argument for compulsion is tough to swallow, but I believe that generations of future retirees will thank us if we do go down this path.
Thank you very much, Alan. I'm struck, actually, sitting here at the stage of the policy exchange and hearing so many people arguing in favour of compulsion. It doesn't strike me as a very policy exchange style of policy. But so I just wonder, is there someone amongst our panel who might be able to put the strongest argument they can against compulsion? I wonder if that might be a kind of a Mark thing, or...
Well, I think there is an issue about compulsion, and I think that when Adair producer's report, and there's great consensus around auto-enrolment, because people actually felt that if you compelled people to save for retirement, it would be seen as a tax. And I think that we're still open to that risk. I do think that we need to increase the contribution levels. And I think it would be interesting to see, as Helen said, that we've seen quite a low opt-out rate. It'd be interesting to see as we move out to the next tranche of businesses whether that continues. And it may indeed, as you move away from large paternalistic employers to smaller ones, you might see that opt-out rate start to increase, which has two things. It sort of strengthens the argument for compulsion, but in a way also makes it harder to do it, because it's much easier to argue for compulsion from 92% than it is from 68 or 70%. And I think at the moment, given the economic challenges households face, I wonder just how many would actually rebel against the idea of compulsion and would see it as an additional tax on their income. And I'm not sure the time is right for that. But I think we may well be forced to do something when we see the opt-out rates for when the next phase of the rollout happens.
James, do you want to add anything to that?
Well,
Obviously in favour, I'm presuming, rather than against.
In favour, is this it's on? I'm in favour of compulsion simply because the numbers stack up. I mean, if we were starting from a different place, then I think you could go down a voluntary route. The fact is that we're starting from a situation where the average pension pot is £36,000. That's so far away from where we actually need to get to that's why I think compulsion has to come. And there's a whole bunch of people, probably in their 30s and their 40s, who are massively under-providing for their pension, the pension pot. And the real risk then transfers to the state. The fact, as in one of the surveys I looked at, is that 1 in 7 people were planning to rely just on their state pension. And I think there's like 1 in 5 were planning for it to be the bulk of their pension savings. So that's where it's not, as you say, it's not normal for policy exchange to say compulsion. It's just it was the pure weight of the numbers. And I do hear what Mark says about you don't want to do it right now. It's one of the reasons why in the paper we also said you'd want to phase it in over a period of time to enable the compulsion to basically come in as people's incomes rise. So I very much acknowledge that you wouldn't want to do it today. But the problem in all pension savings, as Alan knows probably better than anybody else, is that the later you start, the worse off you are.
Lord Turner, I just wonder, and you might want to kind of draw on that as well, but I do wonder sometimes when you hear people talking about this ongoing pensions crisis, do you feel slightly regretful that we're still talking about this now, even after your review and after the changes that came in there? Does that pain you?
Well, not really. I mean, we knew we weren't going to get everything right immediately. And as I say, I do think it's important to reiterate what I said before. We've made an enormous progress. The move away from the basic state pension below the poverty level, continually degrading because linked to prices, to something which will be at 140 quid linked to earnings, as a sort of a clarity of promise, that's what, because you can now tell people what the state pension is. It was incredibly difficult before to tell them what it was, what they were getting. You now can say, look, guys, you get 7,000 quid a year, from the state, as long as you've got, your 35 years signed up. And it does rise with average earnings, so it doesn't degrade through life. You can, through retirement, and you can save on top of that. And we've got auto-enrolment. So I think those are steps forward. Can I answer your earlier question, the compulsion? I said, look, I'm open-minded about it. I think Mark's point is a good one. I mean, once you're at compulsion, it is a tax, and people, respond against taxes, and we have to be honest about that. And so that is an argument against it. And the other argument is people have a variety of circumstances. I mean, you're going to have some people who rationally are happy not to auto-enroll because, they know they've inherited a large house which they'll be willing to sell, or they are saving in other mechanisms. So I think there are some counter-arguments, as I'm open-minded about it. One thing that one might consider is a tier of compulsion with an auto-enrolment on top of that. Now, just thought about it as I could, but you could have a thing which says, we are going to compulsorily have 6% going into your pot, and we're going to auto-enroll you for another 6%, and you can choose to opt out of the other 6%, but the 6%, that's fixed. I mean, once you've got the idea, we could play around with some variants of it.
I'm conscious that we need to have questions, and I'm sure there's plenty of appetite for them. So if you stick your hands in the air, this gentleman here had one. I mean, maybe we'll take 2 or 3 in a go and then try and respond to each of them in turn.
Thank you very much. It's
say who you are as well.
It's Malcolm Small from the Institute of Directors. Sticking with the compulsion thing for a moment, at the IOD, because I'm a pension guy, I get invited out to boards to walk them through how automatic enrolment works. And I've taken about 8 boards through how it all works and all the rules around it, all the entitled job holders, eligible job holders, band earnings, all that kind of stuff. And I start with a fairly interested, engaged board, and in 8 boards of different companies, from PLC through to quite a small company, at the end, every single board has said, oh, why didn't they just make it compulsory and get on with it? Now, my members will shoot me for saying this, probably, but it appears to me that we're going to hit some real problems with the smaller companies understanding the rule sets around auto-enrolment. And I think sooner or later compulsion's got to come. I know I've got a friend from Australia here present, but when we think about compulsion, the point was made there that, you know, people have been through a hard time. In Australia, the compulsion is on the employer, not the employee. And I think one of the other things we'll learn from the auto-enrolment policy as we go forward is we're in the UK asking the employee to do the heavy lifting. And I think that's probably, with retrospect, a design mistake.
Okay, thank you very much. Next question, gentleman here on the aisle, yes. There's a microphone coming up.
Yes, I've been in the industry 30 years, and I think everything that's been done over the last 30 years is good in part. I think the problem we really have is the disaggregation in the workplace. You know, pensions are seen as a separate issue, profit sharing is seen as a separate issue. We don't actually aggregate ways that people can actually save money, and I think, you know, basic auto-enrolment where people are allowed to top up, you know, as the money is available within their corporate lives, within their business lives as sole traders, whatever that might be, would be very admirable. We also need to take a look at what people are actually using this money for as well when they get into retirement. And I think as Mark's highlighting as well, and I think it was James as well, you know, people need insurance products for long-term care, they need insurance products for death and retirement, you know, 5-year guarantee as well, that's a jolly good thing. That's probably gone out with history, but there are a lot of things that we ought to look at that can be done in the workplace or during working lives that can be translated into retirement. We're not really thinking about it holistically enough, are we? And just one word of caution, we really need to think about stranded assets, declining productivity, declining earnings, as Helen was saying, because this is rapidly going to become unaffordable in the next 10 or 20 years.
Everyone's been very harmonious and agreeing with most of what everyone's saying. There must be someone who would like to challenge aggressively. Lady over here. If you just wait for the microphone to come to you, if you can.
Hi, Charlotte Moore, freelance journalist. I want to pick up on something that both Adair and Mark addressed when you talked about charge capping. You were very, very strongly in favour of charge capping, Adair, but to play sort of industry devil's advocate, are you not confusing cost with value? Because Mark then talked an awfully long time about innovation in the decumulation product, and you've got to face the fact that the asset management industry is one that actually suffers from huge diseconomies of scale. If you want innovation and new thought, you need to be nimble and not big. You can talk about economies of scale when it talks about big products, but if you want new ideas, then you have to have like a technology set up where people can go off and think of new ideas. So are you not creating problems for yourself down the line by putting such a fixed level on charges and basically making an easy political win?
Okay, all right, hold that thought, Adair, and then I wonder if Alan or Helen have some responses to any of what we've heard so far. I'm keen to get you involved.
Well, I think all the comments have been broadly supportive of what we've been talking about, particularly on this issue of compulsion and the fact that there's an issue about the timing of introducing that, and there's an issue about the way in which we do it, as Adair just mentioned. So, but I think it's the journey that we need to start at some point fairly soon in order to get on top of this problem. I would obviously, as you might expect, have some sympathy to the last speaker in relation to the charging issue. I mean, I do think there is some low-hanging fruit in getting larger pension pots where you get economies of scale. But there are other costs that people are not, for example, concentrating on, like the price of volatility, which has a real impact on the predictability of savings outcomes. And managing volatility requires a different kind of product set. It does take you away from purely passive products, which can be delivered very cheaply. And I think we need to make sure we don't throw that baby out with the bathwater, while I accept Adair's point that 50 basis points off costs is 5% better income replacement at the end of the savings period.
Okay. Helen, did you have anything to add?
Yeah, I'd just like to agree with everything that Charlotte said. I mean, I think a charge cap is a very blunt tool when it comes to assessing quality. I think that there are instances where you get what you pay for. I think by putting a strict charge cap into place, people could end up getting worse outcomes as a result.
Okay. Lord Turner, did you want to respond?
Can I make two responses? One,
Two quick ones.
The question on the IOD was very interesting, the heavy lifting point. I think it is worth saying, though, that although the individual has to make the decision, the individual puts 4% in, the employer puts in 3%, and the taxman puts in 1%. So we've tried to put somebody else doing a little bit of lifting as well. But on the charge cap, here's why I'm in favour. Just to clarify, the charge cap is not on everything that anybody can invest in. It's on that there must be an option available which is covered by the charge cap. And it probably means the default charge cap. Now, it leaves the provider completely easy to say, look, you have available to you UK equity index at, under the charge cap of 50 basis points, but I think you'd be better off going elsewhere at this thing that I provide at, 100 basis points. And you've got the ability to try and persuade that. But I do think we've got to try and get these costs down. I mean, the fact is, you take a UK equity index, if you are investing through the DC scheme of a large employer with economies of scale, you will be getting your UK equity index probably at 10 or 15 basis points, because that is what the Unilever DC scheme will have to pay the asset management industry to get UK equity index. The ordinary Joe who's not in that, who's a small and medium enterprise, at the moment will pay 75 basis points. Getting the economies of scale of that available, is important, and I think we've got to find a way to do that.
Can I just say one line on that? In support? One line. I totally agree with that point. Schroders, an active management house, in its DC lineup, provides alongside active options a passive option for everyone.
Okay, we take 3 more. Let's go back. So, gentleman there far left, to my left. So that's kind of that side of the room, as it were.
Thank you, Ed. In the spirit of turning this back to decumulation, as Mark said, we spent a little time on this. Could I just, first of all, just remind the panel that we mustn't describe the annuity market as some homogenous market, but of course there are different types now. So for people that have medical conditions or lifestyle, they can actually dial up their income very, very significantly. So just a reminder to all, it's no longer homogenous. Mark, good to have you back talking on this subject. You've been missed, so thank you for that. My question is, are consumers missing out because of the way that some of these products are sold, as opposed to the structure and the manufacturing of the product? To respond to one of Alan's points around how these products may respond to inflation or guarantees or capital protection, all of those features exist in the manufactured product today, but the way that they are sold, to quote the FCA's recent thematic report, those people that buy their annuity directly from their existing life company fail to get the best offer in 8 out of 10 occasions. So is this a advice and distribution challenge rather than a product manufacturing challenge?
Okay, thank you. Two more questions. Okay, there's a gentleman there with the shirt, with a pink shirt.
Hi, Sam Dale from Money Marketing. My question's on the role of financial advice. Mark touched on it before. So basically, how can we boost people getting better financial advice? In the last year, we've had the introduction of the Retail Distribution Review, which was partly driven by both Mark and Lord Turner when they were in their positions. How has that damaged savings, and how can we kind of recover the advice market after that?
Okay, fantastic. And finally, I'll take the gentleman here who's had his hand up all this time.
Mohammed Amin, Deputy Chairman of the Conservative Muslim Forum. Something Mark Hoban sort of almost touched on but didn't quite address is financial education, which is lamentable in this country. And what does the panel think about getting more financial education into the maths curriculum? Because you hit not only the kids, you also hit the parents who are trying to help them with the homework.
Fantastic. Well, three kind of related questions. Mark, do you want to start us off?
Yeah, I mean, I think there is an issue around the advice and distribution. And I looked at the Consumer Panel's report, and I thought it was actually a very powerful indictment of where we're at in terms of non-advised sales, about the websites that are out there. And those websites have mushroomed since the reforms were introduced 2 or 3 years ago, the ABI Code of Conduct, to encourage more people to shop around. And there's a very clear need, I think, for there to be better guidance out there, better information. And we actually need some sort of gold standard products. It really annoyed me to find out that Money Advice Service, actually their annuity comparison table isn't a whole of market table. It's a panel. Now, if anyone is going to produce a market-leading service, it ought to be the Money Advice Service. People should be able to go there and know with confidence exactly what getting the best products there on all products. So, there's a long way to go on that. Sam, let me correct you. The RDR was nothing to do with me. It was the decision of an independent regulator. And I know lots of IFAs invested hopes that I would interfere with the regulator, but that's not something I would make ever a practice of. I think there is an issue about the need to have, I think, more self-help advice. And that's what I referred to in my remarks, that there needs to be something from the FCA. And I know that Martin Wheatley, in response to some questions at TSC, said he was going to publish something shortly, trying to talk about this. And I think it's quite important. Lots of things we do online, yet getting financial advice doesn't seem to be one of them. And I think there's a big opportunity for the mass market to go down that route. So I'm very keen to see what Martin has to say about it.
Okay, now we're getting right towards the end. So perhaps what I might do is I might ask each panellist just a quick sentence, perhaps addressing some of the questions, perhaps addressing something they hadn't thought of before, but just a very quick summation. Helen, why don't you start? Okay.
I'd just like to take up what the gentleman here said. I think we do have a massive issue with financial education. It needs to be brought up in schools. I hate the fact that, people get to the point of retirement and then they're abandoned and they're having to make these massive decisions. They don't know what they don't know. They might think they've made a right decision and they haven't. So I think we do need to see more financial education in schools, and also more kind of highlighting of services like TPAS, which I think are vital in giving retirees the information that they need.
Okay. Alan Brown?
Well, I'd just like to repeat my plea, if you like, that the government look seriously at changing the rules behind annuities, because I do think there's a way of improving outcomes for savers at no direct cost to the Treasury, and we should do that along with education and advice and everything else.
Okay. Mark Hoban, was there anything else? Or?
No, all I'd say is I think what's interesting, and James' report has triggered tonight's debate, but there's a whole sort of slew of things coming out about pensions. And I think there's a real interest now and appetite from policymakers, from regulators, to say how do we build on the reforms we've introduced over the last 4 years, and how do we transform the pensions landscape, recognising that more of us are going to live longer and will have more complex needs in retirement. So it's a great opportunity, I think, to seize.
Financial education is important, but we shouldn't expect too much of it. Broadly speaking, people get into long-term savings, pensions, either because they do it as a byproduct of a contract of employment or because somebody or other compels or persuades them to. Very few people make it as their own choice. The most important area of financial education is on the other side, it's credit. The fundamental thing we have to teach 16-year-olds is that compound interest is a very dangerous thing. It gets very big very quickly.
Thank you. And James, last word.
Actually, I mean, compound interest works on both ways, and that's why you need to start saving your pension as early as possible. So I think, teaching people about compound interest is very important. I mean, I would just echo the point about financial advice, because one of my real worries about the retail distribution review is that there's going to be a whole bunch of people, potentially in the middle in the UK, that actually won't be getting proper financial advice. And we can start with financial education, absolutely right, but that's generations away. There's lots of people out there already that don't understand their pension. That's why they're not saving into it. And we need to find some way of being able to advise these people properly so they can actually save the right amount of money.
Thank you very much. It's just after 7 o'clock. Do get a copy of the pamphlet, which is great, and it's also available online. I've noticed there was a hashtag Help to Save And I had a look online, and very few people have been using it so far. So use it now and talk about this on Twitter or elsewhere. Thank you very much to all of the panelists, and thank you very much to you. Good. How are you?